Heya Cryptozens, welcome back to the Crypto Overnighter. My name is Nikodemus and we do crypto news analysis nightly at 10 p.m. And keep in mind, none of this should be considered financial advice. And it's Saturday, February 25th, 2023. And I live in the Pacific Northwest, so it's a very snowy Saturday at that. But crypto doesn't let snow get in the way, and we won't either. And we've been pretty US-centric for the last few nights. So tonight I want to start with the EU, because on Friday, a senior official from the European Commission suggested that the European Union should think about things like fairness and safety and privacy of data when it comes to regulating the Metaverse. The EU wants to make sure it doesn't repeat the same mistakes that it made with the internet policy in the past. The executive branch of the EU is getting ready to release a policy document on virtual worlds in May. During an event held by the European Commission in Brussels, Vol Volman, who is the director of data at the Commission's digital department, DG Connect, he said that they want to ensure that the development of virtual worlds aligns with the European values such as inclusion, privacy, non-discrimination, and equality. He also said that safety is a top priority and people should feel as safe in virtual worlds as they do in the real world, or even safer. Volman emphasized the importance of providing people with the necessary skills and tools to safeguard their assets, particularly their data in virtual worlds. Volman emphasized the need to avoid repeating past mistakes with the internet and get the regulation of virtual worlds right from the start. Recently, the EU has implemented broad regulations to limit the power of large companies such as Google and Amazon in dominating the online space. The antitrust officials from the Commission are worried about the possibility of similar issues happening in Web3, as those in the past with large companies like Facebook, which has now rebranded itself as Meta Platforms, intending to create its virtual reality online space. Volman acknowledged that the metaverse could have potential advantages like online education or surgery. Still, he mentioned the importance of addressing the drawbacks associated with it. The Central Bank of Jordan has made progress towards its goal of introducing a retail central bank digital currency. An International Monetary Fund technical report on the country's markets has been completed. This is expected to help with the preparation of a CBDC feasibility report. The IMF provided assistance to the bank during a 3-month mission last year, because of course they did. They're central bankers. They're going to help with this. This report was released on February 23rd. Now, from July to September of last year, the IMF gave the existing retail payment market in Jordan a positive review. They said that it's well integrated. The report noted that 2 non-bank payment service providers have generally accessible and appropriate products, and that the country has a high level of smartphone penetration. Even so, introducing a retail CBDC would make financial services accessible to more people who do not have smartphones. This CBDC could also benefit the domestic payment system by allowing payment service providers to use its infrastructure and reducing the cost of cross-border transfers. The IMF cautioned against disintermediation in the Jordanian financial system, as it could contribute to instability during difficult times. The IMF believes that the financial sector in Jordan has strong information security governance and management practices. However, a retail CBDC could increase the security risks as it becomes an attractive target. This report emphasized the need to establish a strong legal framework for a digital fiat currency. The report concluded that while a retail CBDC may have some benefits, it may not necessarily address the challenges faced by the system. However, a cross-border CBDC could be valuable, particularly if the authorities collaborate with other countries in the region. However, no retail central bank digital currency could possibly address the challenge of low financial literacy and the prevailing use of cash in Jordan. The Central Bank of Jordan revealed in February of 2022 that it was exploring the possibility of a CBDC. Now, cryptocurrency trading is currently illegal in Jordan, so that's not an option, at least if you want to stay out of trouble. In fact, their parliament specifically opposed a central bank proposal to introduce crypto trading. Adidas is considering adding cryptocurrency to its Web3 plans. However, it's not a straightforward process and cannot be solved by just adding on a payment plugin. According to Adidas Web3 lead Erica Weiss-Snade, they've discussed the idea, but they're not sure if it solves any actual problems. Now, she was speaking at NFT Paris when she said adding cryptocurrency to Adidas's Web3 plans isn't expensive. However, there are no apparent obstacles to purchasing Adidas products with fiat currency, so it's not really necessary. Instead, the company may leverage its early crypto experiences to build communities and release unique digital drops. And this is something Adidas has started already. Back in December of 2021, Adidas bought a Bored Ape Yacht Club NFT and released its 30,000 NFT drop in the same month. This generated $23.4 million in revenue. Now, Weiss-Snade believes that Adidas may explore the use of ApeCoin and other emerging coins for exclusive drops for specific communities. She thinks this could be more appealing than just adding cryptocurrency as a payment option. Adidas could potentially use Web3 technologies to whitelist users into their favorite sneaker drops, which would align with the company's larger strategy. Using token-gated tactics, they believe that crypto communities could bypass bots and avoid the frustration of missing out on drops. Adidas is currently exploring these possibilities. Citizens Trust Bank has partnered with Circle Internet Financial to store some of its reserves in USDC. This financial institution is regulated by the Federal Deposit Insurance Corporation. This collaboration between Circle and Citizens Trust Bank involves the bank holding $65 million in USDC reserves. The bank plans to use these reserves to provide small businesses with capital and to promote financial inclusion. Cynthia N. Day is Citizen Trust Bank's president and CEO, and she said that this move will also help improve the bank's balance sheet, which is an important consideration. The announcement was made by Circle on February 24th, and we're talking about a real bank. Citizen Trust Bank became a part of the Federal Reserve System in 1947. Over the past 2 years, the bank's deposits grew by $220 million. In 2021, Citizen Trust Bank funded loans worth $157 million. These included commercial, consumer, and residential mortgages. Several other American financial institutions, including the Bank of New York Mellon, Customers Bank, New York Community Bank, Silvergate Bank, Silicon Valley Bank, and Signature Bank, all hold USDC on their balance sheets. Now, stablecoins have become much more popular because of the growth of DeFi in the past couple of years. More users are using dollar-pegged assets to secure collateral, trade cryptocurrency, and to earn yield. However, regulatory hurdles have limited the use of stablecoins for payments. And just between you, me, and the fence post, honestly, I think USDC is the odds-on best option for a private public stablecoin instead of adopting a U.S. central bank digital currency. Don't come for me, you Tether supporters. Stablegains has been taken to court in California. Investors claim that the decentralized finance yield platform misled them. They also claim that stablegains didn't follow securities laws. The plaintiffs, Alec and Arden Ohanian, filed their complaint on February 18th in the U.S. District Court. They say that stablegains moved all of their funds to the Anchor protocol without telling them or getting permission. Obfuscated rehypothecation in full effect. Anchor protocol provided high yields of up to 20% on Terra USD. Now, Terra USD being an algorithmic stablecoin that was created by Terraform Labs. Stablegains was an investor in Terraform. This suit claims that Stablegains knew a lot about UST and Luna, and that they falsely advertised Terra USD as a secure investment. Stablegains promised its customers a 15% return, and then they kept the extra 5% from Anchor Protocol's yields. The plaintiffs claimed that UST was a type of an investment, and that Stablegains broke federal and state investment laws. The complaint also said that Stablegains didn't register with the SEC as a broker-dealer or as a securities exchange. The Ohanian brothers said that Stablegains customers suffered a lot because of the failure of the UST ecosystem in May. When UST depegged, that caused significant problems for DeFi and for crypto markets. And in the end, the Terra Luna ecosystem cost about $18 billion. After the UST ecosystem failed, Stablegains changed its website and advertising to remove the words safe and fiat-backed. The complaint alleges that this showed that UST was never safe nor fiat-backed. Instead of selling assets and giving customers at least some of their money back, stablecoins decided to invest what was left in Terra 2.0 without asking their customers first. Stablecoins started life in August of 2021 and shut down by May of 22. Now, I don't know how much money the plaintiffs want from stablecoins, but they did ask for a trial to take place, so this is probably more than just money for them. 3 U.S. federal agencies recently issued a joint statement. In this statement, they told banks that they don't need to create new risk management principles to handle liquidity risks from crypto. It was the Federal Reserve Bank, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency making the statement. They advised banks to use their existing risk management principles instead. They said that these should be applied when addressing liquidity risks related to crypto assets. This joint statement by the federal agencies pointed out that the liquidity risks for banks when dealing with crypto assets and related participants. They were worried about the unpredictable deposit inflows and outflows. They feel that volatility could cause significant problems. The federal agencies were concerned about the large sell-offs or purchases that could negatively impact the liquidity of the asset. This could result in losses for investors. The federal agencies provided 2 examples to illustrate the liquidity risks of cryptocurrencies. Now, the first is all about the price stability of crypto assets, and that stability is reliant entirely upon investor behavior. This behavior can be influenced by market volatility and other vulnerabilities in the crypto asset sector. These are all things that the bank cannot directly control and so present significant risk for them. The second relates to stablecoins and their demand. The joint statement warned that these types of deposits are vulnerable to sudden outflows caused by unexpected stablecoin redemptions or disruptions in the crypto asset markets, which is a very long way of saying that bank runs on stablecoins might be a problem. The federal agencies agreed that banks are legally allowed to provide banking services for crypto assets, but it's not recommended. However, they did recommend that banks actively monitor the liquidity risks associated with these assets. They also advised banks to establish and maintain effective risk management and controls for their crypto offerings. The agencies recommended 4 key practices for effective risk management. These included performing thorough due diligence and monitoring of crypto assets, considering the liquidity risks, assessing the interconnectedness between crypto offerings, and understanding the direct and indirect factors that could affect deposit behavior. On January 3rd, these same 3 federal agencies released a joint statement. They pointed out 8 risks associated with the crypto system, such as fraud, volatility, and contagion. The agencies emphasized that these risks in the crypto asset sector cannot be mitigated or controlled. They should not affect the banking system, though. This statement also suggested the possibility of changes to crypto regulations, referring to the agency's previous case-by-case approaches. Lawyers for Sam Bankman-Fried have asked for more time to submit a proposal regarding his bail conditions. They filed a request on February 24th with the U.S. District Court for the Southern District of New York, asking for an extension until March 3rd. The legal team also aims to appoint a technical expert in the case and to include additional bail conditions for Sam. During a February 16th hearing, the lawyers decided to hire an expert to discuss the former CEO's use of a virtual private network. Mark Cohen of Cohen & Gressler represents Sam Bankman-Fried in federal court. And remember, this is the criminal trial involving fraud, violations of campaign finance laws, things like that. This is separate from FTX's bankruptcy case, although there seems to be a lot of overlap, given that the same people are at the heart of each of those cases. A filing stated that the parties are looking for a suitable candidate to serve as the court's technical consultant. Therefore, they've requested more time to identify the right candidate. The parties have also been discussing additional bail conditions for Sam Bankman-Fried, but they require more time to complete the discussions. Mark Cohen, Sam's lawyer, said that the government has no objection to this request. He added that the parties also do not object to continuing his current bail conditions for as long as the court deems necessary while the discussions take place. Judge Lewis Kaplan has proposed additional restrictions for Sam's $250 million bail conditions after reports that he used a VPN on January 29th and February 12th. Sam's lawyers say that he used VPNs to watch the football games, but agreed to stop using them until the court decides. Since being arraigned in December of 2022, Sam has mostly been confined to his parents' home in California, but he has had to appear in court a few times to address issues related to his bail conditions. Court documents revealed that Sam tried to communicate with former FTX employees using encrypted messaging apps. Judge Kaplan also hinted at the possibility of revoking his bail, which could result in him being in federal custody until his criminal trial in October. Which, if I were the judge, I would have already done so. Sam knew that he wasn't supposed to be using anything encrypted, yet he decided to anyway, more than once. This indicates to me a continuance of a pattern of behavior of don't wanna. Sam doesn't want to follow the rules, so he doesn't feel like he has to. He didn't want to follow the law regarding customer funds, so he didn't feel like he had to. He didn't want to follow the law regarding campaign donations, so he didn't feel like he had to. And make no mistake, Sam doesn't feel like he has to follow the judge's rules either, so he's not going to. If there is anyone on this planet that understands that VPNs are encrypted, it's Sam. His use of the VPN wasn't due to ignorance, it was insolence. On February 22nd, the court revealed a new indictment against Sam with 12 criminal counts, which is more than the 8 charges he started off with on December 13th. The indictment accuses Sam of conspiracy to commit bank fraud and unlawful political contributions. The indictment claims that Sam used straw donors to make contributions of tens of millions of dollars. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe. Maybe leave a rating or review. And in the meantime, we'll see you tomorrow night.